Tesla's fourth quarter results, they're just crossing the wire. Let's get those numbers. Tesla Q4 adjusted EPS, 50 cents. It looks like consensus was closer to 45 cents. So we got a beat there. Q4 revenue clocking in at $24.90 billion. Estimate was $25.11 billion. Q4 gross margins, there it is, 20.1%. The estimate was 17.1%. Q4 free cash flow, $1.42 billion. The street was closer to $1.59 billion. Let's get your take on this, Adam, because this is another one you own, and the stock's popping about 4%.
Love it, as it should. They beat estimates. Not that I actually care about how many cars they sold, because
why don't you care?
This is a robotics story, Josh. Tesla is already using 10,000 of its humanoid robots, which they call Optimus. Remember C-3PO in Star Wars, right? Oh, Master Luke, right? Literally, the Optimus robot looks exactly like C-3PO, except that it's white instead of gold. And they've got 10,000 in the factories. They are going to be at a 1 million unit run rate, probably 2 years from now. They're going to charge $50,000 per robot. They're going to make net $20,000 per robot. Well, just do the math. 1 million robots, $20,000 of profit per robot. That's $20 billion in profits. Net income. In 2022, the year they sold the most number of cars ever, the profit was $13 billion. Okay, so do the math. In 2 years, they're going to make $20 billion plus the EVs. My point is, they'll make far more money selling these robots than they have ever sold on the EVs. That's why you own Tesla.
I reached out to Cantor's Andre Shepard, who covers the name, likes Tesla.
Yeah.
Humanoid robotics market, here's what he's telling the clients, goes from nearly $3 billion in 2025 to $15 billion by 2030. That would represent a 39% CAGR. We believe this is a material opportunity for Tesla over the long term. So on the call, let's say you could ask Musk about the robots. Would you ask about timeline? Is it fleet size, ASPs? What would you want to know?
Yeah, I want to know the timeline. He has told us that by 2027, 2028, he'll be at a 1 million unit run rate. I'd like him to confirm that. I'd like to see if he could actually do it earlier. There is talk that he will be selling some of the Optimus robots by the end of this year. That would be a big deal because that's sooner than expected. He won't be able to sell 1 million this year, but if he can start selling them this year, that just confirms the thesis. So I'm very happy with Tesla. And again, it's a robot story. It's not an EV story.
So you mentioned the earnings beat there, 50 cents versus 45 adjusted EPS there, beat there, operating income better than expected. Slight miss on the revenue, but still some good updates here from the shareholder deck. Preparations continue in North America for production ramps of Tesla Semi, Cybercab, et cetera, both commencing, and the next generation Roadster, right? So and that includes 6 production lines of new production lines to build some of these new products. What are we talking about here? Optimus robots, right? They said they will unveil the Optimus version 3 in Q1 of this year, which is the production model of Optimus, and that they aim for a production to start at the end of the year with an eventual capacity of 1 million robots, so that's good. Robotaxi stuff, not much there. They mentioned the safety driver was removed in Austin, but not for all cases. No new regions noted. And also FSD testing in Europe and China commencing, but no approval yet.
So let's say you're on the call, all right? Musk says, all right, over to Praz. You have a question or two for Mr. Musk. What do you ask him? What do you want to know?
I think it's got to be robotaxis, right? So I think that they're saving some of that news for the call. So for instance, more about the safety drivers. When are we going to see more of those taken off the roads in Austin? Secondly, what about the expansion to Arizona and Nevada? Is that going to happen? Is that still on track? Do we have any loose timelines there? Are we going to see potentially 1,000 robotaxis on the road by the end of the year? That's what Morgan Stanley believes. So I think a lot of questions around that business, the most sort of compelling, but also the most immediate business of theirs that's not automotive.
Adam, over to you.
Yeah.
Speaking of all things Musk, my friend, you saw this headline today.
Yeah.
The FT reporting SpaceX weighing a mid-June IPO, aiming to raise as much as $50 billion, valuation of about $1.5 trillion.
That'll make it one of the 20, maybe even more than that, biggest companies in the world. And it's a brand new company, SpaceX.
You excited to own SpaceX?
Everybody's excited about SpaceX. And yes, I will buy it. I'm going to keep it small.
You will buy it.
The valuation is very high.
Yeah.
But if you size it correctly, it's okay. In other words, I'm not going to buy a 10%. I'm not going to put 10% of my money into SpaceX, but I'll put 2%. I'll put 2% of capital. I think it's a must-own story, and
How come? Why do you say that, Adam?
Well, because who else is is going to space in this capacity? Who else is launching rockets into space and landing them back on the same pad and reusing that equipment over and over and over again? And where's space going? We don't really know. I mean, it sounds absurd. I feel almost foolish saying this, but right, there's talk of putting data centers in space because it's cold and you don't have to cool them. Space takes care of that for you, and then you just beam the data down. Might that be a business? And yes, it might be. And who is best positioned to do it? SpaceX. Who knows what else is out there for space? So I think you need to be there. I think you need to be part of it.
I mean, you got free energy out in space.
Yeah.
Right. And also, I want to note that
Good
it's going
point.
to be Gemini and Cancer zodiac signs in June because Musk is seeking that planetary formation and also on his birthday.
That's the
He's
hub.
into the stars.
Well, I can't comment about Cancer, but Gemini, the twins. So I don't know where you're going with the twins.
Seth, first of all, just give us your take on this print. We're in the green here. What do you make of it?
Well, I think the market reacted to the strong profitability, adjusted EBITDA, adjusted EPS, free cash flow, all beating consensus estimates. And now we have better visibility on the near-term plans for Robotaxi and Optimus. And so Optimus will enter production in 2026. I think that surprised the market, maybe an accelerated timeline. And we have 7 new cities for Robotaxi expansion in the first half of 2026. It's a loose timeline. I'm hoping to hear more on the call, but all positive things. And we see the stock up after hours reacting to these news.
Now, Adam, let me bring you in here as a Tesla shareholder.
Yeah.
You agree with Seth here? These are the reasons, these are the headlines. We can see this movement in the green.
Yeah, these are the headlines that are driving the stock, but as you know, this is not why I am buying the stock. Yeah, Robotaxi is an immediate catalyst. Fantastic.
It's robots. You're a robot guy.
It's the Optimus robot, and as Praz just mentioned, the company reiterated in the press release that yes, they are on target to produce 1 million of the Optimus robots at some point in the next couple of years, which I interpret as 2027 to 2028. And as I mentioned before, 1 million robots at a profit of 20 million per robot is 20 billion in net income, and that's more than the 13 billion in net income they made in their record year, which was 2022.
Seth, do you share my friend Adam's enthusiasm for these humanoid robots?
Well, I want to hear more from Tesla first about where they're going to use them in their own factories. I know Musk has said he wants to start selling them to consumers by the end of this year. And now anytime Musk makes a bold prediction like that, we do want to give it a few years at least before we think it's going to be set in stone. Yet, if Tesla can find a way to make Optimus robots profitable and helping to make its factories more profitable and useful in a Tesla factory, then they can start selling them to commercial customers, maybe other manufacturing facilities, maybe something like an Amazon warehouse. And if so, then you have a strong commercial outlook for the robots, and then you have a second lever of selling them to consumers down the line. So I am long-term enthusiastic about Optimus, but I want to hear more details about what they're going to do, what their initial capabilities are on the call tonight.
Now, Seth, to Adam's point, which is well taken, there's a lot of Tesla investors. They're not in this company for the EV business. They're in it for the Musk vision. They're in it for the AI opportunities. But on the EV business, team at Canaccord, here's what they say about it. They say Tesla, they say that EV business stands alone, they say, in the U.S. with a truly scaled, integrated EV franchise. In other words, they say EVs in the U.S., Musk is top dog. Do you agree with that? And what is EV demand overall? What do you see for that market going forward, Seth?
Yeah, so Tesla is still the king in the U.S. for EVs. They're the only one that can offer a long-range midsize SUV or sedan at an affordable price that isn't too much greater than the best-selling internal combustion engines in that category. So a Model Y, not too much more expensive than a Honda CR-V or Toyota RAV4 with the new standard prices. And so I think that does make Tesla still the king of the U.S. EVs. But for the first 3 quarters, we're going to be lapping the end of the EV EV tax credit that ended in September. So I expect EV sales in the US will be down for the first 3 quarters. Now, Tesla might be down by less if it can make a compelling argument for the Model Y by improving its full self-driving software. And so we'll as the year plays out, we'll look for that. But ultimately, I think EV sales and Tesla sales will be down in 2026.
Seth, what about FSD, full self-driving system? You saw this, how Tesla's now saying it will be only available as a subscription. How, as a financial analyst, did you read that? Do you read that opportunity?
I think that was always the plan, was to transition this to a subscription-only basis. And eventually, Elon Musk wants to raise the price once it gets to an unsupervised full self-driving, when it becomes either level 3, level 4, level 5. Either way, when Tesla takes over and as the passenger, we no longer have to be paying attention to the road. We can look at our phones. We can take a nap, read a book, do something else. And I think that's going to unlock a lot of extra profits as they can raise prices with those software like very high gross margins.
Final question, Seth, kind of a bigger long-term question. You know who else is very interested in self-driving cars and robots? Jensen Huang. He is very interested. I have seen some smart folks, Seth, argue NVIDIA is a long-term competitive threat for Tesla. They argue, listen, this is an underappreciated risk for Tesla. And I'm curious, you know the company backwards and forwards. What's your answer to that?
Well, what NVIDIA is going to offer is going to be the ability for an automaker to create an AI self-driving system, but ultimately, you're still going to need to create the software, the system yourself. You're still going to need to train the software. And so we see right now Rivian is trying to do this with their own system, independent of NVIDIA. And so I do think longer term, this can help other automakers develop their own AI software, which doesn't mean they're necessarily going to have to license it for a company like Tesla. But in the meantime, Tesla's going to maintain a very far lead. They're well ahead of the game. Only really Waymo can compare with their autonomous driving software, and Waymo does not offer a consumer version. So I expect Tesla will continue to maintain its lead. And while NVIDIA might be embarking on a real-world AI platform and be a competitor for things like Robotaxi and Optimus, right now Tesla's in the driver's seat. And for auto, I think it will maintain the lead.
Seth, thank you. Appreciate it as always. And Adam, thank you as well, my friend, for joining in all the earnings action and fun.
Thank you.
Meta, just now, releasing its Q4 results. Joining me for the hour as we cover all of this, we've got Adam Johnson, Bullseye American Ingenuity Fund Portfolio Manager. Let's get right to these results. So Meta Q4 EPS, I see $8.88. I don't see a clean compare yet on the bottom line. But Q4 top line revenue, $59.89 billion. Consensus was $58.42 billion. I'm looking for ad revenue. There it is. Q4 ad revenue, $58.14. The street was at $56.79. Turning to the forecast, the Q1 revenue, Meta is giving us a range here of between $53.5 billion to $56.5 billion. The street was at $51.27 billion. That CapEx number, there it is. We're looking for 2026 CapEx. Meta is giving us a range of between 115 to 135 billion. The street was closer to 110.6 billion. Just looking at the immediate reaction here, we're down nearly 3%. Now remember, heading into this print, the stock was basically flat over the past 12 months. It was actually down about 10% since they reported earnings in October. Now bulls will say, and by the way, there's plenty of them, more than 90% of analysts have a buy on this when they'll talk about industry-leading revenue growth, they'll talk about scale advantages, engagement. They will certainly talk about the attractive risk reward, but investors have had these questions about the company's big capital outlays, all the spending here on AI data centers, hiring the pricey AI talent, more questions about where the return is on all that. The initial reaction, we're lower here. I have just the man to talk to about this because, Adam, you own Meta.
I do.
Walk me through why you own it. What do you make of the print?
Oh, you have to own Meta. Meta's.
You have to own it.
Yeah, you have to.
Why?
Well, you have to own all the core ingenuity companies. Meta, the obvious ones that we always talk about. Meta, Amazon, Google, Tesla. I would add Salesforce.com, ServiceNow, Palo Alto Networks.
Interesting.
These are just core, big, best-in-breed companies that you have to own.
How do you define best in breed? When you're screening best in breed, why does Meta show up?
Well, do you know another social media company that has the reach of Meta? Nobody else reaches 2.2 billion people every day, except arguably Google, but that's different. That's search, and they dominate search. That would be best in breed. Salesforce.com is best in breed, literally #1 for customer relationship management. We could go on and on. Palo Alto Networks for cybersecurity. That's best in breed. Meta is best in breed. What excites me about Meta is that they're monetizing every single aspect of it. And remember, Meta now, WhatsApp, has become the prime B2C, business to customer way of communicating, right? It used to be you'd call a 1-800 number or you'd send an email. Well, now actually all those bots, hi, my name is Susan, how can I help you today? That's all powered through WhatsApp, and they're monetizing it because they're getting paid for it. They're getting paid for absolutely everything they do. They're now selling ads in Reels. So that's a whole new thing that just started last week. So I think you have to own Meta.
But let me ask you this: how does Zuckerberg? How does he excite more people like you're excited? Because this stock, as I mentioned, we were down 10% since last time reported. We're now battling back here.
Yeah, of course.
We're actually edging higher. But they see things like this. Look at this head. 2026 total expenses 162 to 169 billion. Street was close to 151, and folks are just wondering,
they can afford
where's all the return on this?
Oh, they can afford it. I mean, this is not an issue. There are very few companies that are able to grow 20 to 30% per year at scale. Meta is one of them. Google's another. Amazon's another. In fact, even higher growth than that. Nvidia is another. That's why these companies trade at the prices they do, both the stock prices and then the valuation. So I'm very comfortable paying 25 to 35 times earnings for a company that's growing 35 to 40% per year. I mean, for perspective, the S&P 500 trades at 22 times earnings, but is only growing at 13% per year, right? So I'd rather pay up to get growth that in some cases is double or triple what the S&P 500 is giving me. And that's why I say you have to own these. And you can't worry about quarterly numbers. I mean, think how absurd that we come here every 12 weeks and say, okay, how are the last 12 weeks? And what are they going to tell us about the next 12 weeks? Imagine if you treated your children like that. You said, all right, kids, I got the report card. So the past 12 weeks are a little rough. How are you going to improve, over the next 12? I mean, really? They'd tell you, Dad, get lost.
Scott, it is always great to see you and to have you on the show. Meta just reported. Get me your take on the print, Scott. We were lower, then we bounced higher. What do you make of it?
Well, expectations for expenses have been rising throughout the quarter, and so I think that set the bar pretty low. Meta's spending a lot of money on CapEx and operating expenses in 26, but there's no real growth story in consumer, that comes near what Meta's doing right now. I mean, the business exceeded expectations in terms of revenue growth by 300 basis points, and then they guided at a midpoint to 30% revenue growth for the first quarter of 2026. So this story from a growth standpoint is very much intact, and I think that flips the narrative to the spending being very much justified.
And all the spending, Scott, when your clients ask you, okay, where's the ROI on all this spend, you tell them what?
The ROI is initially showing up in the revenue growth. When you look at operating profit dollar growth, they will grow operating profit dollars in 26, but Meta's building for the next 10 to 15 years and then reporting revenue on a quarterly basis. So it's one of the very few companies where AI monetization is showing up in real time, in results. And so you have short dated improvements in revenue growth, which should continue, and very long dated spend, which again, I think is on a time horizon of 10 plus years. And so as you get to 27 and 28, I think you'll see leverage again in the business model. And keep in mind, Meta trades at 18 times forward earnings now on a GAAP base. It's a very cheap stock for the growth you're getting.
So Adam, bring you in here as a Meta investor, shareholder, believer.
Meta shareholder.
You agree with what you're hearing from Scott here?
Oh, I completely agree with what Scott's saying. And herein lies the opportunity for investors. There's an arbitrage, naturally, for thoughtful long-term investors like Scott and I, who are taking a long-term view of the company. The company's taking a long-term view of itself. That's why it's making all these investments. And so we come in every 12 weeks and try to make these, we try to game the earnings. We don't. but the market does, trying to game earnings. Did they beat this metric? Did they fall short on that metric? And the stock moves around 3, 4, 5% moment to moment. And as you can see, the stock is now up 4%. It was down 4% as soon as that one number came out where they're spending more on AI than was the estimate. So yeah, Scott's got it absolutely right. This is a long-term story, and Meta is managing the business, not the quarterly earnings.
Scott, I was listening to my buddy Josh Brown's podcast last night. Josh, very smart guy like yourself, Scott. He was talking about Meta, and he kind of framed it like this. I'm just interested to get your take. He kind of suggested, Scott, that Meta has had sort of a story problem, a narrative problem. Because again, the stock is popping here, but heading into the print, Scott, it was down about 10% since they last reported in October. I guess Josh's point was, to paraphrase, they seem to have all these balls in the air, and Zuck has seems to have all these sort of side quests. And he was suggesting, Scott, maybe they would benefit if they were just a bit more clear in their AI story and strategy. And I'm just curious what you make of that.
Well, I think that's a valid point. And I think if you do back up 12 months, and you insert Alphabet in Meta's place and vice versa, the stories were exactly the opposite, and then Alphabet got much cleaner as the year progressed. And I think with Meta, the beauty of that is they have the ability to now provide clarity around the business. They've defined this kind of expense growth. And then I think you'll see the management team talk, quite a bit about the growth prospects of the business. And you're beginning to see, even right now and after hours, the beginnings of a narrative flip again that begins to favor Meta. And Meta trades, this is not a knock on Alphabet, but it now trades at a 6-turn discount on a multiple basis to Alphabet, despite the fact that it's growing almost 800 basis points faster. So Alphabet's margins aren't declining the way that Meta's are, but there's a heck of a lot of growth here.
So let me ask you, Scott, so you're bullish on the name, like Adam, but when clients ask you, Scott, hey, okay, it's a buy, it's an outperform, but what are the risks I need to think about, over the next 12 months? What do you tell them? What should be on their radar?
So outside of macro, so company specific, I think it would be, that the company begins to spend in areas that don't stimulate growth so that you can't see the benefits of it. And so revenue growth decelerates as they're spending. So the core business is perceived as deteriorating, and the company continues to put its foot on the gas in terms of spend. That's clearly not happening right now. In fact, the opposite is happening. Revenue growth is accelerating. But if that flipped, so the core business started to decelerate meaningfully, that would be notable, and it would be problematic for the stock.
Let me ask you, you mentioned Alphabet there, Scott. I'm just curious, any read-throughs from Meta to Alphabet, those earnings on deck, of course?
So the revenue growth healthy, you can't read much in terms of Alphabet's kind of infrastructure, but the vast majority of the business is the advertising, which the advertising industry continues to be strong. I think the primary challenge that Alphabet has is, even though search should beat and the cloud business should beat, the multiple's gone up a lot. Stock's up 60, almost 70% year to date. It's a double off the bottom. And so I think the greatest challenge that Alphabet has now is just valuation, but the underlying business is performing phenomenally well. And I think Meta further validates that on the advertising side.
Scott, as always, we are lucky to have you on the show for that analysis. Thank you, sir.
Thank you, Josh. Appreciate it.
Stock down a swift 6% here.
Yeah, that's right. We actually saw Microsoft beat on the top and bottom line, but the shares are falling, and it's not exactly clear why at this point. They came close to what expectations were for the commercial cloud business, as well as intelligent cloud. We're just in line with expectations for more personal computing. That's where you have the Windows sales, things like that, search revenue, but nothing was too far out of line. It may have been that expectations were higher than what the street originally had, and that because they just came too close to those, we're seeing this pullback in the price. We have to wait for the actual earnings call to get any kind of clear idea as to what CapEx looks like and what capacity constraints are, although they did say that their remaining performance obligations are above $600 billion, and that's basically contracts that Microsoft has that it hasn't been paid out for yet. And so that's revenue to be expected. A lot of that, though, coming from OpenAI. So we have to see more what Satya Nadella says, what Amy Hood says on the earnings call in a little bit.
All right, Dan, thank you. Appreciate that instant breakdown, my friend. Kimberly, the results cross. Initially here, we are in the red. What do you make of the print and the reaction?
Sure. Well, I think people are really concerned of, is Microsoft going to be part of AI in the future? And what represents that for them is Azure. Are people buying access to Azure? And it was a little bit of a disappointment. And I think even that little bit of a disappointment can throw at least investors who trade after hours into just dumping the stock, right? And that's what you get with, well, I mean, it's only down 4.5%, but that's still kind of, throwing the baby out with the bathwater, maybe.
One question from Microsoft, Kim, is, obviously this is a company, the roots are in software, right? That's its history. And
right.
There is this sense out there, and this, investors, they just think AI is the death of software. I mean, they won't go near those software stocks. And I'm just wondering, how, as a longtime watcher of Microsoft, how do you think that software business navigates, Kim, this new AI future?
Sure. Well, I think people really are leery of things like Salesforce that have been growing because they've been adding functionality. And now people think, well, you could just, use Claude and write whatever you want. Well, as an ex-software engineer, good luck with that. I think it can help people write code, but I'm always kind of skeptical about that. But the real driver is this: where's the data? Where does it live? And for most businesses, it lives in some sort of Microsoft product. It could be Word, it could be Excel, or it could be their database. But Microsoft will get paid because we need access to that data. And that's how we make data. We use those products to store it. And I don't think anybody's going to want to rewrite like a data repository. So those core Microsoft Office 365 revenues are probably safe. And I just don't think that vibe coding for enterprise is going to be a thing.
On Azure, Kim, we know the company's been dealing with these capacity constraints, so hey, they're going to invest a lot in capital expenditures. Do we have any sense of when those constraints might ease, Kim?
No, we don't really. I think everybody is asking that question, and in fact, I just saw Lam Research kind of pass by. So I think that people are continuing to spend, right? The designers and the makers of semis are buying Lam Research. Everybody and their brother is expecting for more spend on just the basics. So it really is up in the air.
We've been talking, Kim, about AI and the cloud. What also, Kim, about the PC market, the gaming market? I'm curious how you see those markets evolving 2026 and what that means for Microsoft.
Sure. Well, it really is kind of a back seat for them, although they are huge businesses in and of themselves. Now, in 2025, we had the benefit of Windows 10 being, taken or no longer supported. So that did drive some sales of PCs. But I think it's going to be kind of a lackluster, maybe 18 months for the PC for a couple of reasons. Really expensive DRAM and memory is probably going to chill people who are kind of marginally thinking about upgrading. But then also, I think that just the people who upgraded recently are probably got pulled through because they had really old PCs with Windows 10 on it. So that probably pulled a lot of things forward. And gaming, it's so small part of Microsoft, I don't even look at it, sorry.
No apologies necessary, Kim. I'll get you out on this. This week, Microsoft also unveiled the second generation of its in-house processors. My colleague Dan Halley was writing about that. How should investors, Kim, interpret that news?
Well, I think it's a really broader look at AI in itself, that maybe people who think NVIDIA won, you could take that off the table. Amazon has their own chip, Microsoft has their own chip, Google's going to have their own chip. Everybody's going to have a flavor that makes their tech stack work best. And I think that's great because it makes NVIDIA, who is the leader, make better products. Isn't that what we all want if you're a capitalist? Is a good market with everybody trying to outperform each other? I say yes.
Kim, appreciate that instant analysis. Thank you so much. Eddie, one, what do you make of the decision? And two, Loretta, when do you think cuts could resume?
Well, I think it was the right decision. I agree. There's no rationale for cutting at this point. They had already brought the funds rate down 75 basis points. So that, was their insurance against the softening in the labor market. And as they pointed out in the statement, the unemployment rate has stabilized a bit in the, recently. So that's on the labor side. They're still going to be watching that because there's still, dual-sided risks. They also said that in the statement. The inflation side, they have to watch that too, because inflation has been above 2% for over 5 years. They haven't gotten it back. There's reason to believe firms are telling us that they're planning to pass on some more of the tariffs this year. They've avoided it probably as long as they can, some of the firms, and so they're going to be passing them on. So the inflation numbers, they're still going to have to see how the tariffs play out, and hopefully, if their story of how they're seeing the tariffs plays out, they'll get to see goods prices begin to fall again, and then they'll get inflation on that downward path. But there's no reason or compelling reason now to take another move down in the interest rate. In fact, there's reasons to think that there's some tailwinds to growth going into the beginning of the year with the tax cuts. People are going to get bigger refunds, so they're going to feel that they have more money to spend, and businesses will get that depreciation, the full expensing, so they're going to feel that they also can. The one tailwind, though, is the continued uncertainty that is plaguing this economy, and partly because of what's going on geopolitically, our own policies not sort of settling down. And so that's something that I think could affect the economy going forward. But all signs suggest that the economy is in a good place now to really watch and wait.
So Loretta, it's Julie here. So what do you think, what are you going to be most closely watching to look for a sign of change, to say either, okay, we feel more comfortable, we can start to cut more, or more worried? I mean, is it more the labor market? Is it inflation? And do you think the Fed's been doing a good enough job at articulating that challenge?
Yeah, I would love to see the FOMC do a better job of really laying out what their rationale is for their policy decisions. And that means talking about what their outlook is, what the risks of that outlook are, but also then using that to sort of explain. And if we see, for example, the labor market deteriorate in a material way, then we're prepared to use our policy tool again. And I think that'll be the catalyst for the next cut. It'll have to be something, I think, in the labor market, or more confidence that the labor market is really stabilized and inflation is on that downward path. But they're already very near or close to neutral, I think. So they don't have that much further to go to neutral. I think if they were to articulate that rationale more fully, I think it actually is a good thing in terms of preserving Fed independence, because then the next chair that comes in will really have to articulate in a similar way what their policy view is. And I think that's a better way of preserving that independence and making sure that the Fed's making policy decisions based on the right data, economic analysis, and not being driven by politics. And I think whoever becomes chair, they're going to have to really show that they're doing policy in a credible way. There's going to be some skepticism around whoever becomes chair. And building credibility means laying out the case. And if the previous chair and FOMC have laid out a case, the new chair is going to have to do more than just say, I read the data differently, and so therefore I want a different policy. They'll have to really articulate a rationale that may perhaps differs from the previous rationale, but they'll have to address it. And I think that's something I'd like to see the Fed doing in the final meetings with Chair Powell, is to really lay out their rationale for how they've been setting policy and why their policy is appropriate.
Loretta, on that point you're making there, Nick Timmeros over at the Journal has a piece out. Here's what he writes. He says, Trump wants something that may not exist. A new chair who will pursue his demands for lower interest rates while still commanding enough credibility on Wall Street and from his colleagues to deliver them. What do you make of that, Loretta?
Well, I think, the president, it's his right to say kind of what his policy views are. I think what's been very unhealthy here is the vitriol and the challenges and the really blatant attacks against the Fed policy, which undermines the public's credibility with the institution. So it's basically trying to tear down the institution rather than really having an adult conversation about my preferred policy path would be this, and the Fed isn't doing it. So already the new chair who comes in is in a very difficult position, because I think Nick is right. That person coming in will need to build their credibility with the markets, but also the general public as well. And every time the president goes out and attacks the Fed, right, it raises questions. Even if the Fed's doing exactly what they're supposed to be doing, which is basing their decisions on the economic situation and really setting policy, only caring about achievement of the dual mandate goals that they've been charged with achieving. The fact that this question has been raised makes it that much harder for the Fed to actually do its job and do it well. So again, we're in a situation now where you can't wind that back, but hopefully the new chair comes in, they will be held to account in terms of having to really articulate a really credible case for whatever policy decisions they want to make, because they're going to have to bring the committee along with them. And I think anybody in that job is going to take the job very seriously. And part of that is knowing that, the U.S. economy really depends on sound Fed policy. And frankly, the world's economy also depends on the Fed setting sound policy. So I guess I would think that any chair coming in would feel that weight, and that would dominate over these external forces that are trying to get policy to move in a particular way. You can have different views. If the new chair comes in, they may have different views than the current chair. But as long as they're really articulating a credible economic case, then I think they'll be able to get the consensus of the committee to go along with that. And then if the case isn't credible, or if the policy turns out not to be the right policy, then the Fed will have to go in a different direction, because they're going to be focused on those dual mandate goals. Maybe that's naive of me to say, but I do think the weight of that job and the importance of it will weigh in a positive direction for whoever comes in as chair.
I'm joined now by Treasury Secretary Scott Bessent. Mr. Secretary, thank you so much for joining me. It's great to have you on Yahoo Finance.
Great to be with you.
We are here today at the Trump Accounts Summit, and it feels like an inflection point for capitalism, for bridging the gap for income inequality. What do Trump accounts mean for the next generation of Americans and for our economy?
Look, I think it's taking the capital markets to everyone. I always say it's the biggest merger in history. It's Wall Street and Main Street. When I was a kid in South Carolina, I didn't know about the stock market. I just knew something bad had happened in Wall Street in 1929. And now, for the next 4 years, every child getting $1,000 put in an index fund in their Trump account, they're going to learn about the markets. Their parents going to learn about it. And the president has done peace deals, trade deals, and tax deals, but I think this could be his most enduring legacy, because these won't open up for 18 more years. And if someone rolls it into an retirement account, it won't be for 65 more years. But giving everyone a piece of the American dream, I think, is a game changer.
Now, every child who's born for the duration of this administration gets $1,000 to start, and they can contribute up to $5,000 a year, kind of similar to an IRA. Will it automatically be invested in an index fund?
Yeah.
How will that work? And will there be, perhaps at some point, company matching as companies match 401ks?
Oh, no, we have company matching now. So everything will be contributed into the index fund, the lowest cost, broad-based broadly diversified. But we're going to hear from a lot of great American companies today who are going to contribute. Parents can contribute, family members can contribute, and the other thing that we are seeing is some great American philanthropists are also contributing. So Michael and Susan Dell are contributing to a lot of the children who aren't eligible for the $1,000. So you can open an account per child up until age 18. Michael and Susan Dell have contributed $6.25 billion to all children in America who are not in the top 20% economically of zip codes. Ray Dalio and his wife have adopted the children in the state of Connecticut. We just heard Brad Gerstner has adopted his home state of Indiana, all the children under 5 years. I think we're going to have a big announcement on Oklahoma today. We hope by the day the accounts are rolled out, July 4th, July 5th, that all 50 states will be spoken for.
Could we see even more than $1,000 perhaps at this point?
Oh, it could be much more. I mean, it could be topped up. And the other thing too is, I don't know if I would want to be a toy maker now, because I think friends, parents, grandparents, aunts, uncles will maybe contribute to the accounts instead of give a toy.
You're creating the foundation for wealth for the next generation by giving them a jump start. What about giving children, Americans, the tools they need to manage themselves? For example, we know that American history is mandated to be taught in classes, middle school, high school. What about a federal mandate to teach investing in middle school and high school? Is that something the administration would support? I know you're big on financial literacy.
Yeah, so I've done a lot of work with financial literacy. I don't know if we do a federal mandate. We would encourage states to do it. I think about 2/3 of the states do it now. And I think the great thing about these Trump accounts is that for a lot of families, the 38% of families have no investments in the stock market. This will change that, and I think that it will become the ultimate real-time learning lab, because as the children, the parents look on their phones every day, every week, every month, and they'll become interested. At Treasury, we have Financial Literacy Month, and we're going to keep pushing out more and more. And I think many of this, so the other match that can come is from states. So I think we're going to have 20 states, and I think the states are all going to have financial literacy requirements maybe to receive the donation.
You're also head of the IRS. What are you seeing in terms of account signups at this point for the Trump accounts, and what are your expectations for tax season?
Well, we've already seen 600,000 signups just this week. So the TrumpAccount.gov, if any of your viewers want to go on. And for the IRS, I can see there's going to be a big refund season, because one big beautiful bill was signed on July 4th, and we did not give guidance on withholding changes for the president's signature policies: no tax on tips, no tax on overtime, no tax on Social Security, deductibility of American cars on the loans. So working Americans going to have the very nice tax refunds, encouraging everyone to change their withholding now. Their take-home pay will go up. So I was in Iowa with the president yesterday. We were in a diner/restaurant, and the wait staff there couldn't have been more excited.
I also cover the Federal Reserve, and the Federal Reserve is meeting today. They are expected to hold interest rates steady after cutting 3 times at the tail end of last year. I know that you, the president, have called for the Fed to continue cutting. What is your message to the Fed today, and do you have any update on the search for the next Fed chair and when we could possibly see an announcement?
Yeah, and I haven't necessarily called for cuts. I just said that I think the neutral rate's lower, and I think that inflation is moving down to target faster than maybe some members of the board or the Reserve Bank presidents do. So, but my message is always have an open mind. In my lifetime, we had Paul Volcker, who was a great Fed chair. Then we had Alan Greenspan, and Volcker really had to take a lot of tough medicine, bring inflation down. Greenspan, on the other hand, in the 90s could see the productivity boom that was coming. He had an open mind, and he let the economy really grow at its potential. Government paid down tremendous amount of debt thanks to the Clinton administration, the good work of Newt Gingrich and the House Republicans. So what I'm saying here is have an open mind that growth does not equal inflation, and let's see what happens. And in terms of Fed search, we got some great candidates. I was talking to the president about what he's thinking on the plane back from Iowa last night, and my inclination is we may hear something in the next week or so.
Mr. Secretary, thank you so much for your insight. So appreciate it.
Good to see you.
Good to see you as well. That's Treasury Secretary Scott Bessent. Joe, great to see you. Thanks for joining me.
Great to be here. Thank you.
I do want to kick off the conversation with these Trump accounts because I was looking at some projections. These Trump accounts being rolled out on July 4th, the Treasury giving $1,000 to every child born during the duration of this administration. And if you were to contribute $1,000, if you would have that $1,000, I should say, you would earn $5,800 by age 18. $18,000 by age 28, and if you contribute $5,000 a year, you could have over $1 million by age 28.
Right.
How does this work, though, exactly?
So essentially, as you said, you sign up on trumpaccounts.gov, look for Form 45, 47 when you're doing your taxes. Everything goes live, or you get your money effectively around July 4th, $1,000. Then you could contribute up to $5,000 annually. And based on compound interest and historical equity returns, that $1,000 plus the $5,000 per year annual max contribution is worth over $300,000 by age 18. By age 28, it's worth almost $1.1 million. Again, maximum contribution, the initial $1,000 plus $5,000 every year thereafter.
Is it automatically invested in an index fund?
It'll be a low-cost index fund, something analogous to like the S&P 500.
All right, switching gears, the Fed is meeting today. We know that the Fed cut 3 times at the tail end of last year, the administration in favor of cutting rates further. The Fed is expected to stay on hold today. What is the administration's message to Chair Powell and the rest of the central bank?
The Fed has talked about rates being high relative to their projections of neutral, and even the central tendencies within the FOMC, their forecasts show that rates are expected to go lower. The Fed has conditioned the market not to expect a January move, and the Fed never goes against strong market expectations. If, however, inflation continues to move lower and we get a disinflationary boom as we believe we're in at the moment, then that would argue for lower rates. So I'm hopeful that if the Fed is applying the right models and methodology, they will lower rates to at least a neutral, if not accommodative rate, because as inflation comes down, holding monetary policy steady means real rates are rising. Monetary policy becomes more restrictive. And we know policy is restrictive when we look at many cyclical parts of the economy, such as housing. Rates are too high.
Secretary Bessent had teased that we could get an announcement from the president on who the next Federal Reserve Chair will be post Davos. We're at Wednesday now. Granted, we still have a couple of days left in this week, but there are some reports that the president is rethinking whether the 4 finalists have what he wants to be Fed chair. What is your sense of where the process stands now?
The president has 4 great candidates to choose from. You know, the president's talked about doing it sooner and then he's pushed it out. He wants to be very careful and very thoughtful in his deliberations and his thought process. Historically, these Fed chairs oftentimes don't get announced until late February. You know, we're just used to maybe the president moving so quickly and trying to always go from one accomplishment to the next. So I think, you know, we put a historical precedent on it. You know, it's not unusual. We don't know yet, but I would take the president and the secretary at face value. They're thinking about it, or the president's thinking about it, and we'll get an announcement in due course.
Does it worry you that Senator Tom Tillis has said that he is going to block confirmation, block the process until the criminal investigation into Chair Powell is buttoned up? Do you see Governor Myron, who was supposed to step down by the end of this month, staying on for much longer?
Stephen Myron can stay on until that role is fulfilled. I'm very confident that the president, whoever he chooses, will do an excellent job in running the Federal Reserve, and that person that will be picked will go through the Senate confirmation process and be successfully confirmed.
You're not worried, though, it's going to be dragged out because of what?
I don't believe it'll be dragged out. No, there's, again, the Secretary Powell's term as chair, I believe, ends May 15th of this year. I think that's the exact date. There's a lot of time between now and then, and I'm expecting a successful resolution and the president putting somebody forward who will do a great job running the Fed, whoever that turns out to be.
We're looking at potentially, switching gears, a partial government shutdown at the end of this week if the Democrats don't support funding DHS. Where do things stand now? What is the administration willing to do to move the ball forward on this?
Well, the House has voted on a bipartisan bill, and Speaker Johnson may decide he doesn't want to vote again. Senator Thune is exploring some other options. That's going to be in Congress's, it's sort of in their court at the moment, and we'll see where it goes. I hope it doesn't happen. There are many Republicans that don't support a shutdown, even a partial shutdown for that matter, and hopefully won't revisit anything like we did last fall. But my fingers are crossed, we'll see what happens, but I don't know more than that.
And as I mentioned at the top of this interview, we are here at the Trump Accounts event. And I do want to ask you, because we've seen the Dell Foundation contribute over $6 billion, $250 per child under 10 for lower income zip codes. Is the Treasury looking at getting other commitments from other philanthropists and private sector?
Yes. Certainly, and there are other big philanthropists that have contributed. For example, Ray Dalio has committed. Different states are talking about instituting the programs and encouraging people to participate. I would expect as people learn more about it, because the more we've seen people hear about it, oh, this is a great idea, it's bipartisan, I would expect more people to contribute and this to be a real raging success.
Senator Cruz, thanks so much for joining me today here at the Trump Account Summit in Washington. We know that these Trump accounts are going to be rolled out on July 4th, $1,000 per every child born, but only for children during the duration of the Trump administration's term. Does Congress, do you see a way to codify this, to extend this?
100%. So I drafted the provision, the Trump accounts, and when we wrote it during the process of reconciliation. It was part of the working families tax cut that the president signed last 4th of July. And I think it may well be the single most important part of that bill because it is going to transform every child in America. Every child in America, number one, is going to realize the benefits of compound growth. And every child in America will have an investment account opened for them. Parents, employers, family can give $5,000 a year. That grows in a tax-advantaged account. But critically, that account is invested in the stock market. It's invested in the S&P 500. So, look, if you assume, let's say a little girl is born this year. She'll have an account open for her. That account will automatically be seeded with $1,000. And if her parents or family or employer puts $5,000 a year, if you assume that account grows at the historic rate of growth of the S&P 500, which is 7% a year after inflation, by the time that girl's 18, she'll have $170,000 in that account. And if she keeps contributing to it, by the time she's 35, she'll have more than $700,000 in that account. And that's not just the kids of rich people. That's the kids of a single mom waiting tables. You want to talk about changing the entire country, but secondly, this is what I'm really excited about. We are going to be creating a whole new generation of capitalists because every kid in America is going to be an owner of the biggest employers in America. So if you imagine 10 years from now, a little boy will pull out his phone, and instead of thinking big, scary corporations, instead of thinking, gosh, capitalism is terrible, that little boy will look at his phone and say, hey, I own $100 of Apple. I own $75 of Boeing or $50 of McDonald's. And suddenly our kids have a stake, an ownership. That is exciting. You're right, the way it is written, it is for a few years. I think it is 100% that Congress is going to extend this program and make it permanent. When I drafted it, that was absolutely my intention, to have this be a permanent and transformational program.
To your point, you said children are going to be able to pull out their phones and say, I own $100 in Apple or McDonald's or whatever. And we know that these dollars are going to be invested into the market. But we also know that a lot of these children growing up and a lot of Americans don't have
the personal skill set to invest. So we know that American history is mandated in schools. Why not mandate at a federal level investment classes for middle schoolers and high schoolers so they have the tools, especially once they turn 18, to know how to manage their own money?
So I think the right place to do that is at the state and local level. I don't want the feds mandating curriculum. I don't want Washington deciding what curriculum your kids are taught, what curriculum my kids are taught. I think that should be at the state and local level. I think you're seeing a lot of state and local levels saying financial literacy matters. We're going to try to teach our kids. And one of the great things about these Trump accounts is they're going to be a natural vehicle for teaching financial literacy. Again, in second grade, the teacher will be able to say, oh, okay, everyone, pull out your phone and look at your Trump account. Look at what you invested originally, look at what's been invested over time, and look at the growth. And suddenly the stock market isn't just sort of strange numbers that sometimes appear at the bottom of a TV screen. Suddenly the kids are like, wait a second, look at this grow. And I think what you'll also see is you'll see kids as they get a little older saying, you know what? For my birthday, instead of giving me some toy I don't need, maybe you can give me $50 or $100 in my Trump account.
Well, that would be nice. Have some stock.
Yeah, like that. The ability to think like investors. This will naturally prove financial literacy. And when you're an investor, it changes the way you view the entire economy, the entire country.
Switching gears, Senator, Democrats in the Senate are furious over what's been going on in Minneapolis. They are threatening to have a partial shutdown of the government later this week. How do you see things now? Are Republicans willing to give any consents? Do you see coming to the middle at all, or are we barreling towards a partial government shutdown at this point?
Look, I think it is very likely that the Democrats are going to force a government shutdown. We saw a couple of months ago the longest government shutdown in U.S. history. Chuck Schumer and the Democrats forced that right before Christmas, and they did it really because they wanted to throw a temper tantrum, because they were mad and they wanted to show their left-wing base they really, really hate Donald Trump. If you look at immigration enforcement, one of the big reasons President Trump got reelected is the Democrats spent 4 years with open borders, and we saw 12 million people invade this country. My home state of Texas was on the front lines of that invasion. We are now seeing the president, number one, in terms of securing the border, do you know that illegal border crossings have dropped more than 99%? I mean, it's staggering success. And I got to say, I don't understand it. My Democrat colleagues have decided they are the party of illegal immigration. They are the party of the violent criminals and the gangbangers that they released, of murderers and child rapists. And I think it's really unfortunate. I think we are very likely to see a shutdown.
How long are we looking at, though? Is it at 45 days again?
It certainly could be. It's up to Chuck Schumer. I mean, the way the Senate works, you have to have 60 votes to fund the government. We only have 53 Republicans, which means we cannot pass this without at least 7 Democrats. The reason we had a 43-day shutdown is the Democrats wanted to throw a temper tantrum. Remember, Schumer is really afraid of being primaried. He's afraid of being primaried from the left. AOC is in New York. She's breathing down his neck. And so he's trying to appeal to the really angry left-wing activists. I think when it comes to ICE, the Democrats have decided, they're very explicit. They want to abolish ICE, which is to say they don't want to enforce immigration. They don't want to deport criminals. They don't want to deport gang members. Look, we saw one of my colleagues fly down to El Salvador and have daiquiris with an MS-13 gang member who's being prosecuted for human trafficking. It used to be a bipartisan agreement we should lock up criminals, and I think it's unfortunate the Democrats have abandoned it.
Really quick, Senator, before I let you go, do you think that Kristi Noem needs to go?
Oh, look, I like Kristi. I think she's doing a good job. I have encouraged the administration in terms of messaging. I think there are a lot of Democrats and a lot of folks in the media that are using what's happened in Minneapolis to try to change the narrative. And I think, listen, it is tragic when any American citizen is killed in an interaction with law enforcement. The 2 individuals who were killed were both actively impeding law enforcement. That's a dangerous thing to do. If you go and try to stop a police officer on the street, particularly if you're using a deadly weapon, there's a real risk of lethal force. But I think the tone in communicating matters. And so I would encourage Kristi and everyone else to focus really on, look, the people that are being arrested are really dangerous criminals. You're getting people who've committed horrific crimes that are being taken off the street. And I got to say, the protests in Minneapolis, they're not organic. They're paid for, they're organized, and they're designed. They're from the extreme left wing. They're designed really to foment chaos and violence. And I think every Democrat should ratchet down the rhetoric. You got a lot of Democrat politicians that are just throwing gasoline on the fire.
Senator, we'll have to leave the conversation there, but thank you so much.
Thank you.
$100 billion. It's actually more than that by now, isn't it?
It is. So that was when I wrote my note at the end of last week. We're approaching $125 billion. So you're right. We haven't closed the month, so it isn't higher than what we saw last year. But really strong demand sets the stage well. We had a record $1.5 trillion in ETFs last year. It feels like maybe that's the new floor. That's the new normal, which would be a great thing for investors and, of course, the ETF industry.
So what's going on this January? I mean, because it's been a January that has been seen a lot of tape bombs, as they call it, like a lot of headline risk, a lot of volatility. What has that driven people into ETFs?
So it has, and some of the areas that we've identified are closely related to that. So, for example, active fixed income ETFs. They were very popular last year. 40% of all fixed income flows went into active fixed income ETFs, and that trend has continued. We've seen PIMCO's PYLD, we've seen BlackRock's BINC, I guess that's an iShares named product. We've seen Fidelity have some success with its total bond ETF. Given the volatility that's happening in the fixed income markets and the uncertainty, even though many people expect the Fed to do nothing today, and perhaps in the short term, there's still a lot of uncertainty, you turn to an active manager when you're looking for that. And that's actually one of the topics we're going to talk about at the Exchange Conference, active fixed income ETFs gaining ground.
I'm curious then, is the driving factor behind active fixed income ETFs mostly institutional money versus retail investors?
So it's a combination. And so I guess institutional in that maybe we're talking about advisors or people who are running model portfolios. We are seeing them increasingly turn to active fixed income ETFs to choose where they want to have the exposure. But the trading that we're seeing in small amounts for active fixed income ETFs also shows a positive sign. The Fidelity Total Bond ETF is one of those products, very popular on Fidelity's platform based on the data that we've seen.
Interesting. Okay. And then another area here is thematic ETFs, which, I mean, are kind of a stalwart, right? But are there different ones that are sort of driving that demand right now?
They are. So for the last 3 years, we've really seen artificial intelligence focused ETFs be very popular, and that's a trend that people still believe in, and we at VettaFi still believe in. But we've seen some of the products that are the leading ones out there, like iShares BAI, which was very popular in 2025. It's only received more modest inflows. What we've seen is that the more defense-focused ETFs, so Global X has a defense technology ETF, SHLD, which was popular last year, a little bit under the radar because it's not AI specific. It's been very popular this year given the geopolitical tensions. And there's a new ETF, the Rex Drone ETF. The ticker is DRNZ. It just came out late last year. It already has 60 million in assets, which is relatively good for a new ETF, but it's up almost 30% for the year. So investors that have gone into this ETF have been rewarded. We think that's a theme that many people are going to pay more attention to as the year progresses.
Interesting. Okay. And then something that we talk about a lot here with Markets Guest is the broadening, right? And I assume that that's happening within ETFs too.
It is. So these were products that are outside of the S&P 500 or not specific to the S&P 500 or the NASDAQ 100 that were unpopular last year. So Invesco has the S&P 500 Equal Weight ETF, RSP. It was among those large ETFs that bled money in 2025. It's actually the third, I believe, most popular ETF this year in terms of net inflows. So investors are buying into that diversification and getting the S&P 500, but all of the stocks. And so you don't necessarily have as much exposure to Apple and Microsoft and NVIDIA. You have the other stocks. The other one that caught our eye is the Financial Select Sector SPDR ETF.
from State Street. I actually changed the name, and there's a lot more words in the front of it than I'm forgetting right now.
We're talking the XLF. Isn't
XLF.
It? Yes. Okay.
Yeah, so
easier to just say XLF, right?
And so yes, so XLF also bled money last year. It's been very popular this year, a top 10 asset gatherer. So people are looking outside of the technology or the communication services sectors, and financials has been one of those beneficiaries.
Something else, Todd, I'm interested in, as you've been talking, when you were talking about tech and you said that AI ETF, BAI, is seeing smaller inflows, but you didn't say outflows. And you've been talking about all these things that saw outflows last year. In January, does anything stand out for actually seeing outflows, or is it just mostly characterized by smaller inflows in certain areas?
So, well, we've had a great start to the year. So there are some products that are seeing outflows. So even though small cap ETFs some of them have been in favor. Small cap ETFs have performed well. The iShares Russell 2000 ETF has been bleeding assets this year, and we've seen investors go towards some higher quality exposures towards small caps. So the iShares S&P 600 ETF, IJR, has seen some inflows. Avantis has a small cap value ETF that's seen inflows, that's actively managed. And then there's more modest flows going into a higher quality small cap ETF from Victory Shares. The Victory Shares small cap free cash flow ETF, SFlow. So we are seeing investors, they're either rotating within a certain investment style, but many things are doing well. This is on pace to be another record year.
I have sort of a bigger picture ETF explainer question for our viewers here as we talk about inflows and outflows. Now, even if something has inflows, it doesn't mean the price goes up. Even if something has outflows, it doesn't mean the price goes down, right?
That's correct.
And small caps are just one example of that. Can you explain that to people when we talk about inflows versus price?
Sure. So money going into an ETF means that the ETF asset manager has to go and buy some shares the way that you might think of. A lot of the trading that happens within the ETF ecosystem, I'm selling and you're buying, and that trades and those paths connect one another, and it doesn't impact the overall ETF. But what we are also seeing is that ETFs, even as they're growing in size and scale, 1.5 trillion as I keep referring to last year, most of the money that is tied to individual stocks is outside of the ETF wrapper. Either people are owning individual stocks, people are owning stocks through a mutual fund wrapper. So the demand that we're talking about doesn't necessarily mean that ETFs are in favor, and there are ETFs that are up in value this year that have seen outflows.
Right.
Silver ETF, for example, a lot of trading happening within that ETF in SLV that happened this week. It's up really strongly, but people are taking some profits in the ETF because it's done so well.
Gotcha. Okay. That's an interesting example, and that is one that has seen a lot of activity along with GLD and some of the other precious metals ETFs.
Yeah, commodity ETFs there's only so many things that we can talk about, but commodity ETFs have been very popular this year also.